Today, I want to talk about the concept of value investing. I came across a letter by an investor, and I don't care about names here, it's not important. It's a pretty decently regarded investor, an asset manager who wrote a letter, and he's also an alumni from the Chicago Business School, so kind of share that with him. And I feel bad about it. I feel bad that people from Chicago have this orthodox view of investing, which I think is wrong, and I want to talk about this. This is the Not Even Wrong podcast. It's February 28, 2021. This is Krim Delco. It's a Sunday. Since the last update, we are down 1%, so we are now down 3% for the year. The market is up roughly 2%, so we're underperforming by 5%. Let's jump right into it here. So there is a letter written by like I said, pretty well regarded asset manager, and he talks about value investing, and in particular he talks about things like crazy things like Tesla. So he thinks that Tesla absolutely makes no sense, that the company and the stock are both way overrated, and everything will fall down and everything will fall into place. And I don't know, let's just assume the person doesn't have any political agenda or anything like that. There is simply a certain way of thinking, which then leads you to conclude that a stock like Tesla doesn't make sense. So let's go step by step. What is value investing? What is the doctrine around value investing? Or what is the principle around value investing? And then what is the conclusion? And I want to give these people a benefit of the doubt, because the same way we at Orange Capital Partners have a principal stack, so have these people. So the principal stack means that you have a certain set of principles under which you invest. And even though the world is very complicated, the world is very volatile, if you stick to a principal stack, and assuming you have the right principal stack, you should therefore also succeed in investing. And if you don't succeed in investing, at least you should be able to match your principal stack with your portfolio. So even if you have the wrong principal stack, but you have the right portfolio based on your principal stack, and then you end up not making money, it's because you chose the wrong principal stack. And I think this is what's happening with value investors. So value investors in general say that you should only invest in companies that are fundamentally cheap. And fundamentally cheap in value investing is, in my view, and this is the problem. I think there's two problems. There's no clear definition of what it actually means to be fundamentally cheap, or what is an intrinsic value of a company, really. You can say two things about this. You can say one thing is that every company fundamentally is only worth what its intrinsic value is worth. Or you can say, and this is, I think, where the mistake is with value investing, that they say very often that it is based on short-term metrics. This is the problem. So I've read a little bit of Benjamin Graham, and I've read all the investor letters that Warren Buffett wrote. So I think I have enough understanding about value investing, in the sense that I think I know what these people are thinking. What these people are thinking is, I want to be safe. And the only way I can be safe is if I can project short-term cash flows against my intrinsic value. Otherwise, I run the risk of having way too much optionality in the cash flows, and that is very difficult to value. And I think this is in general what value investing is, and this gentleman that wrote this letter also has that kind of view. So he's saying, look, if I don't have any kind of line of sight of cash flows, so if I don't have short-term cash flows that I can bank on, then my investment is way too risky, and therefore it's not worth it. And then if I have companies like Tesla, where the value of the company is based on future cash flows, and cash flows way far in the future. In fact, almost any venture capital, Silicon Valley type investment generates its value primarily from the very long-term cash flows because of the growth. And I think this is the key problem here. If you're a value investor, a la my example here, a la this gentleman, let's call him Mr. A. So if you're like Mr. A, you're basically saying you're not going to invest in anything which can have future large cash flows. And this is the problem. I mean, you can follow that principle. That's fine. There's nothing wrong. But you're foregoing an amazing amount of wealth generation. Now, I want to ask a few questions to better understand the value investing principle. For example, I want to ask, well, why are you not interested in companies that have a large growth and therefore have future cash flows which are immense? Why are you not interested in that? What is the risk? And the answer could be, well, it's way too difficult to project those cash flow. Therefore, I'm putting a very large discount factor on them, and therefore they're non-existent. So we can talk about the discount factor, which is a subjective thing. And I can say, well, fine, but let's say I've also read the investor letters of Jeff Bezos, and Jeff Bezos is very consistent in the way he thinks about his company. It's about cash flow, it's about selection, it's about price. So if you look at it that way, what is so complicated about that? You can then suggest that he will be very successful with this company, generate a lot of cash flow in the future, and therefore give the company a lot of value. The reason I'm using a company like Amazon is because Amazon was an internally overvalued company. It's still overvalued, and no value investor ever touched it. Well, you're foregoing trillions of dollars of market cap creation if you don't touch it. So as an asset manager, as an investor in asset, if your expectation is to generate wealth by investing money in the stock market, well, you have to take into account the most value generating assets out there. You can't pretend they don't exist, or even worse, call them stupid. And I just want to quote a recent interview that Peter Thiel gave, and he's, Peter Thiel is Peter Thiel. Being Peter Thiel, he goes out and he says, well, of course, you invest in the most stupid stocks and you make the most money, because being contrarian is what really pays off in the market. There is a certain mechanical truth to it, that if you put your money where nobody else is putting it and you're right, you will by definition make a lot of money, because that's not being priced. But what he's also saying is, he's mentioning, for example, Jim Cramer talking about FANG stocks, and that sounded very stupid in 2014. Turns out that these stocks generated more value than the whole venture capital industry, and by far more value than everybody else in the S&P 500. Why? Because these companies have large growth and their values have grown because the cash flows have grown, and also the future expectation of cash flows have grown. So this leads me now back to Orange Capital Partners and the way we think about this. So the way we think about this, we invest in fundamentally new concepts and engineering practices with large impact. So here's already, by definition, our principal stack requires us to look at fundamentally new concepts. We can't invest in something that is already established. We are, by definition, always at the edge of, is it going to work? How is it going to work? What is possible? For example, with Tesla, we are investing in a variety of optionalities that the company brings with it, because the company is continuously using fundamentally new concepts and engineering practices, not just in the car manufacturing on that side of the business, but in many other areas. So this is a plethora of optionality that we're buying with Tesla, and we're also buying engineering practices, so which really means, in plain English, execution. It is actually working what they're doing. This is not just some theoretical thing. And with the CRISPR side of things, we're also buying into a fundamentally new concept. We just heard an interview between Vijay Pandey and Jennifer Doudna, and she's talking about these enormous the enormous potential that is out there. In particular, since we have now the combination, we have the mix of genetic editing, and we have the AlphaFold revolution, or the ability to predict how proteins fold, so we can linearly decipher how in a digital form we go from zeros to ones to proteins, and proteins then they have functionality, which of course they're the workhorses of biology. So these are fundamentally new concepts with potentially great impact. Now, of course, there is also, like she says, for example, the delivery problem hasn't been solved. There are a lot of issues that we have to be considerate about, but nevertheless, there is a tremendous amount of opportunity to be captured. And of course, we can't value a company like Beam Therapeutics or Twist Bioscience based on the future cash flows, like the next year's cash flows. It just makes no sense. I mean, we would forego opportunity for wealth generation. We would forego opportunity to participate in something very exciting, and that just wouldn't be It's not the right thing to do. Now, we could change our mission statement. Say we're doing value investing. We're only going to take what is in plain sight, so the cash flows of the next couple of years, and then we're going to grow them at a reasonable rate and do a DCF, and this is the value of our company. We're not going to add too many options here. We're not going to allow for too much optionality because that is not under our control. And we're only going to buy whatever looks like that. Now, let me tell you something. First of all, we have two stocks in our portfolio that fit that bill very well, Intel and RTX. They both are solid businesses that have been around for decades. They have very predictable cash flows in the near future. And the DCF, no matter how you look at it, makes them definitely relatively cheap to their own history and totally cheap to the rest of the market. And those are the two stocks that we lost money in the last 18 months. So, what is this telling us? This telling us, first of all, that if our whole portfolio was invested in such stocks, we would be foregoing opportunities. Second, the market is not pricing that stuff anymore. The market is not giving value to stocks and companies that have predictable cash flow. This is almost the exact opposite of value investing. And I can see why value investors are so emotional about this. Now, I don't want to discard value investing. I think value investing is a little bit like the Newton laws of physics. It's wrong, but it's a very good foundation on which we can build good predictions. But we're always going to be wrong, and we're going to be particularly wrong when it really matters. So, in the case of Newton physics, when it's really small and really large, that's when we're wrong. And then when we really want to change things, we either go nano or very big. And in that middle space where sort of there's incrementalism and adjustments, and we can build a little bit of a better Golden Gate Bridge, and we can maybe make a little bit of a better TV, all these things, there Newton's physics work. And the same is with the University of Chicago School. The University of Chicago School really has as a foundation the efficient market hypothesis. And even though most people don't accept it, and that includes, by the way, even Richard Taylor and his behavioral finance crowd, even they believe in efficient markets. It's just that they're saying the efficiency needs to be improved. That fundamentally, humans are able to price things properly, that humans are able to analyze information and then price things. And fundamentally, that is actually true. That is actually true. The problem is that and I don't want to go into this is a whole other episode, but I would say even the behavioral finance crowd says that because all they're saying is, okay, fine, in the process of pricing stuff, we're making mistakes, we have heuristics and psychological biases, but if we could adjust for them, then we would be able to price stuff correctly. And the point here is that in at least currently, the way the financial markets are thinking is, look, there is a tremendous amount of optionality, and I don't want to forego that. And there we have examples such as Apple and Amazon, and recently also other companies like Google, and there's plenty of other companies that are creating enormous amounts of value, and we don't want to forego that. Now, we could call that bubble, or we could call that a change in paradigm. I'm calling it a change in paradigm. And I just want to give a quote from Saint-Exupéry's Le Petit Prince, which hopefully can illustrate that a little bit better. Here's the quote: "If you want to build a ship, don't drum up the people to gather wood, divide the work, and give orders. Instead, teach them to yearn for the vast and endless sea." So what is he saying here? This is, by the way, a quote out of No Rules, Rules by Reed Hastings, and Reed Hastings is using this quote to to get the point across that you need a North Star, and then you need to be able to adapt according to the path that takes you to that North Star, instead of being sort of a command and control type company. But this also applies to investing and wealth generation. There's two types of wealth generation. One is the one command and control. You have all control, everything is priced, and you kind of the way you generate wealth in this old Chicago thinking type world, in the value investing world of Warren Buffett, it's that everything is priced, but you have the power to generate wealth. So Coca-Cola has the pricing power, they have the mouth, they have power. The word power is always important. And in this new world, there is something else which generates wealth. And it's a little bit more like Saint-Exupéry says. It is the North Star. We want to decarbonize energy. We want to decarbonize transport. We want to go to Mars. We want to change the internet, bring in trust and identity through the blockchain. We want to bring quantum computing to solve massive problems. We want to use biology for regenerative growth within biology and life sciences and energy and other areas where we can use the knowledge of gene editing and gene and protein folding to actually create organisms that fulfill certain tasks that we would like them to fulfill. So these are all North Stars. This is yearning for the vast sea, to use the analogy of Saint-Exupéry. And for that, you obviously have to have a leap of faith. There are tools that you can use. We've discussed it at length in this podcast. We have a principle stack that is building upon itself. So there are it's kind of like a Lego thing where you have one thing. We have the David Deutsch is the beginning of infinity, is kind of the base, and then we have the innovation stack. We have 0 to 1, sort of maybe to be more precise. We have the base, which is David Deutsch, which says anything is possible within the confines of the laws of physics. Then we have 0 to 1. You need a unique approach. You need to be different. The innovation stack is more of a principle of, okay, you start solving small problems, create problems, solve better problems, create better problems, solve them, and therefore you build an innovation stack which first of all gets you to that North Star, and second also makes you impenetrable from competitive perspective. And then we have the innovator's dilemma, which really in a nutshell says that every company creates disruption through the cost structure. The cost structure defines the success of a company and also makes the competitive response impossible. And that's kind of what the innovator's dilemma was trying to explain. Why do very well positioned companies miss on disruption? So to summarize here, I think the value investing approach, which has been has been a doctrine since the success of Warren Buffett, and is also being taught in schools like University of Chicago. I think it is right in principle, like the Newton's laws of physics, but it misses out a lot of things where it matters, in particular for wealth generation. And the problem is that it is based on certain fundamental principles, like, for example, predictability of cash flow and lack of optionality, or less optional, less risk is defined like as optionality, and that is exactly what you are trying to achieve, which is bring in optionality to generate the wealth. Now, the Chicago school might be able to adjust this by saying, well, if you price that risk properly, and for example, if you take into account the ability to, for example, forego returns for a long time and things like that, maybe then you can actually invest in these types of things. But anyway, this particular episode is not meant to adjust the value investing strategy. It's just meant to explain that certain principles can put you in a sort of in a pigeonhole where you're not able to do things that might be very beneficial to you. And that's what we believe is the problem with the value investing approach. The investing approach that we choose, which is to invest in fundamentally new concepts and engineering practices with large impact, it has its drawbacks. First and foremost, it's risky, and second, it makes us forego certain opportunities. For example, we are not able to invest in macro relative value type strategies because they don't really fit into our mission statement. But that's fine. We've discussed this, and we might be able to either adjust our mission statement or just forego those opportunities. As long as we have sufficient opportunities within our mission statement, we don't have the urge, nor should we go and pursue other opportunities. There's enough, the space of possible outcomes within our mission space is plenty for us to generate the kind of wealth that we hope to generate. Thank you.